We're Compound Everything, and we enjoy talking about markets and investing and building wealth. And last week we did a quick summary of all of Jeff Bezos' shareholder letters from 1997 onward. And today we are going to jump off of that and discuss free cash flow, which, according to Jeff Bezos,
is their most important metric when looking at investments.
Right. And before we go any further, if you can like and subscribe this video, that is super helpful for our channel.
Yeah. So in the 1997 Amazon shareholder letter, the first one he ever did and made public to shareholders. So in that letter, he talks about if faced with the decision or the choice of optimizing or maximizing GAAP accounting earnings versus taking future free cash flows, they'll take the cash flows every time. He said that in 1997. And so call it, 8 years later, he expounds on precisely why that's important in his 2005 shareholder letter, which is where we're going to dive in today.
And I think in our last video, we said about this, he really does a great job, and he takes the idea of why free cash flow is a better metric than earnings and explains it so a young child could understand it.
A young child or someone like me.
Fair enough.
So what he says is, he says oftentimes in business, earnings and free cash flows are obviously not the same. And so he gives an example in 2005. He takes a hypothetical business, and this pretend business. It's a transportation company, and the transportation company can get you from point A to point B in no time. And it's completely ingenious. Runaway success. It's amazing, but it's expensive to build this machine. The machine is $160 million to build. Can transport a maximum of 100,000 people per year, 100,000 travels per year, and each trip costs $1,000.
Okay.
And with each trip, I think he said in his example, there's $450 of called electricity costs and equipment costs and stuff like that, and then an extra $50 of costs on top of that for labor and things like that. And so he assumed in his example that the machine just maximizes, like you said, it's a runaway success. Like every slot's full, like forever, in terms of for the whole year, they sell 100,000 units. And so going through the example, he breaks down, the depreciation and amortization and whatnot, because the machine in this example only lasts 4 years. And so going through it, I'm not going to go through all the intricacies and the numbers and whatnot, but in the end, initially, he says that if you're the owner of this business, you might look at it and go, if you look at your earnings are amazing. And let's say you decide to go, well, in year 2, you buy another machine. And wow, your earnings have grown 100% from year 1 to year 2. And then so in year 3, you buy another 2 machines because, well, this is just a runaway success. You're just going to keep going. And then in year 4, you buy another 4 machines. So you've got a total of 8 machines.
Because you have so much demand.
You've got so much demand, right? You haven't saturated the market yet. And from an earnings perspective, the earnings have gone up 100% year over year from year 2, from year 1 to year 2, year 2 to year 3, and year 3 to year 4. So you've got 100% growth year over year. Amazing. Who wouldn't want to own that business? Right? But the trouble is, if you go back to what the example was there, the machine only lasts 4 years.
Right, so there's a lot of CapEx.
There's a lot of CapEx to that company. Essentially, he boils through it, and he says, well, if you break it down, the free cash flow is actually, rather than growing 100% per year, the free cash flow is actually negative.
Right.
And so it's actually a money-losing business as time goes on. So what can appear to be a very good business on the surface is actually not a very good business in the end.
And it's interesting, you said he wrote this one in 2005.
Yeah.
Because Amazon's earnings weren't great.
Right.
But they had a good free cash flow.
That year I think their free cash flow was something like $470 million.
Yeah, exactly.
Yeah.
And every investor and every analyst, it's all earnings per share. Did they beat earnings? Did they miss earnings?
Yeah.
What are the expected earnings?
Right.
Everything is earnings. So he obviously was feeling the frustration of that and of Wall Street focusing so much on earnings.
Right.
That instead of actually, really breaking down why Amazon free cash flow is what matters, he took it and did the inverse and said, yeah, this company has good earnings.
Right.
Wall Street would be going bananas.
I think partly that, but also partly to reassure his shareholders.
Yes.
That, you know what? We are generating free cash flow. If you look kind of under the hood of what we're doing, yeah, our earnings don't look stellar, but our free cash flow is there. And where do dividends and things like that come out of? Well, they come out of free cash flow. They don't necessarily come out of earnings. So,
and what helps us make it through a hard time
is free cash flow.
It's free cash flow.
Yeah. And so just as per his example, his point was there was no scale at which you could scale that business, that hypothetical business he gave, that would lead to a profitable business ever.
Mm-hmm.
And
even
so,
though there was demand.
Even though there was demand, even though it was like a fantastic invention,
Mm-hmm.
under the parameters he set, there was no way to generate a free cash flow. And the free cash flow was what was important. And that was a bit of an extreme example, and there's often more subtleties there.
Yeah.
Real businesses maybe don't have. The takeaway point to that is look at the statement of cash flows. He said they don't get enough examination generally.
Yeah. So now, interestingly enough, after we had read through the Amazon shareholders, you ended up listening to an interview by Ted Coombs.
Yes.
Todd
Coombs.
Todd Coombs. I can never remember which.
Ted Wexler and Todd
Ted,
Coombs.
Ted and Todd. I mean,
Yeah.
They're portfolio managers at Berkshire Hathaway.
Yeah.
Portfolio managers. And then you went and listened to an interview or a lecture with Ashwath Damodaran, the self-proclaimed Kim K of value investing.
Yes, that's right.
And you said it was interesting because Bezos, from 1997 onward, it was free cash flow. He never deviated from that.
He never deviated from
it. It was always free cash flow, free cash flow. And then you heard Todd Coombs say they like earnings, earnings per share and earnings, right?
Which I found interesting.
And then you, after that, so you're like, okay, so, you know,
made a mental note.
Yeah, made a mental note. You're like, okay, Jeff Bezos is cash flow, and Berkshire is earnings. And we've heard Buffett and Munger also talk about earnings. And then after that, you listened to Ashwath, and he said,
gosh.
So then Ashwath Damodaran, in that particular lecture or paper, whatever you were reading, said that it was, again, cash flows, particularly when talking about
technology
companies. And so that was interesting when you talked to me about that, because we know Berkshire tends to shy away from tech companies.
Yeah.
And so, you know, net earnings, owner's earnings, all of that, earnings per share, might be more important for certain companies, but then cash flows for others. So what are your thoughts on that?
Maybe in part it depends on the paradigm you're looking at. Like where's the universe of your investments? Right. As to maybe whether or not earnings might be somewhat more important versus cash flows. Although I'm starting to see the argument and the reasoning behind what Jeff Bezos is saying regarding cash flows. And sometimes cash flows will more approximate earnings than others, it sounds like. But in the face of technology stocks, maybe that was one of the things that Bezos was trying to highlight necessarily in that industry, is that deviation. Now,
what was it that Ashwath said why was it that he said you should focus on cash flows in the technology sector? Now, he was, I think, talking about Meta.
Because a lot of I guess a lot of the accounting standards are fairly far behind. His take on it.
Okay, so when GAAP accounting standards were created and maybe, you know, even updated, they were based more on industrials. We didn't have this tech when we didn't have these.
The business models were different.
Right. Okay. So the accounting standards are behind. Yeah. And got to catch up. Therefore, with certain companies, we can attribute cash flow as the more important metric.
Right. Well, and interestingly enough, and I'm going to kind of summarize Jeff Bezos' thoughts with this. Jeff Bezos says this, and he's right. He says, why not focus first and foremost, as many do, on earnings per share or earnings growth? The simple answer is that earnings don't directly translate into cash flows, and shares are worth only the present value of their future cash flows, not the present value of their future earnings. So cash flow is king.
Now, what I took away from just our conversations lately after reading the shareholders letters and then you talking about Berkshire and Ashwath is that what you really want is probably a company that has both.
Yeah.
For myself, because I am not Coombs or Buffett or Munger. I am not that smart. For me, maybe I want to take what all of these great investors say and look for companies that have fantastic earnings, fantastic free cash flow, just fantastic everything, and happen to go through some sort of event that is not permanent, causes their stock to drop, and then I can jump in.
Yeah. I think generally speaking, you know, the lesson I'm taking away from that is very similar, although a little deviated in that don't just look at the PE ratio. PE ratio doesn't tell you the whole story necessarily on a company.
And don't just look at the growth of earnings.
Don't just look at the growth of earnings. So look at the growth of cash flows, because that does become important. And I think we'll have to do a little bit more digging on the importance in each sector. As an investor, looking at simply PE ratios and whatnot is probably not, at the end of the day, the end of the story.
It's very interesting to see how accounting and business is fluid.
For sure.
Because in a previous video that we did, and I can't remember which one it was called, but You know, we talked about how price to book
Mm-hmm.
and book value is not the same metric it once was, particularly with tech companies again.
Right.
And all these tech companies that have really emerged in the past 15, 20 years, even 10 years,
Mm-hmm.
right? The idea of software as a service, like
Yeah.
those types of tech companies have really changed. If that's a sector that you're going a mile deep in,
Mm-hmm.
you really have to know how accounting pertains to that sector, because accounting doesn't necessarily work the same.
For sure.
And book value was another example.
Yeah.
So as What the Modern says, cash flow is one. But we noticed that book value is not, you can't use it as you could in days past.
No, I mean, and that makes sense. If you're looking at industrials with hard assets and
Mhm.
land and buildings and equipment and things
Right.
like that, you're going to come up with a very different assessment of the importance of book value in terms of valuation of the business than you would for something like a software company.
So another lesson that is very valuable is how the investor has to always keep learning,
Absolutely. Yeah.
right? And you have to keep current.
Right.
Right, and you can see that in Buffett. He has changed his style of investing, I think, more than once.
For sure.
And he's always, he's keeping up and he understands. And, even people questioned why he invested in Apple,
Right.
right? Because they kind of knew he was a value guy.
Yeah.
And it didn't make sense.
Right.
But he obviously understands as well
Yeah.
that there are different rules for different sectors.
Right.
So you named all of the shareholders' letters, or at least you had started. You had given each one a title. So what did you title
Ooh.
2005?
2005, I titled The Free Cash Flow Letter.
The free cash flow letter.
Yes.
Okay. So if you are interested in why Jeff Bezos continued from his very first shareholder letter and onward to
Mhm.
really stress the importance of free cash flow for a business like Amazon,
Yeah.
you can go read that letter, because it really focuses and zones in on why that free cash flow is important. So that's everything, and a nice short video
Yep.
on Amazon and free
Free
cash
cash flow.
flow. Hope it's helpful. Again, if you can like and subscribe our video, it's super helpful. And if you have anything to add about accounting, free cash flow, or business in general, put in the comments.
Sorry.